Hey everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today we're going to go ahead and solve another loan problem. This one's going to be worth $50,000, and we're going to do it very, very quickly. It's not going to take 10 years, as in the case of this one individual. 10 years at 10%, $660 a month. They want him in that loan for the rest of his life. We're not going to do that. We're going to be taking that 10 years and changing it down to 10 months. We're going to see if we can do that. So before we get into that, though, I want you to like, share, and subscribe so that everyone around the world can know the power of velocity banking. Now, just in case you are discouraged about the credit card interest rates, I want you to look at this.
Our friends hit credit card users with higher rates in response to regulation that may never arrive. And so this is just something that the banks do. They want to make sure that they are not losing their investment in those people that they've allowed to have their credit cards. And so they hike the rates, just in case that legislation comes along. And some are saying that it is not, but we want to show you what they're going to be hiking it to. 35.99%, and this is actually a change from 2023. These are the rates as far as Big Lots is concerned. Rewards MasterCard, 34.99%. We've got a lot of 34s, 35s. I think the lowest one here is in the 20s. If we can just keep on going, let's see. Yeah, I think the lowest one would be 29.99%. And so what does this mean? This means that, those who have the lowest credit scores, because it still goes by the credit score, is going to look forward to these type of points. However, not if you're doing the velocity banking method and you're knowing how to pay these down. We switch from the 35.99. It'll be just like you're just paying the 10% or even lower. All right. So let's show you how we do that.
Wasn't that something? Wasn't that something? And so you see that the interest rates, at least for now, are going to continue to be as they are. Some are going to get 25%, 27, 30. But when you're a velocity banker, the interest rates do not matter as much as the time and balance. And so that's why regular money max account holders, they're like, well, so what? The interest rate's going to go up 30%, 40%, 50%. I don't care. I know how to take care of my loans. And this is how they do it. Well, no, not really. They actually just plug their numbers in a software system, right? But we're going to go ahead and show you, if you want to go ahead and do a caveman dive into how we do this velocity banking method, I'm going to show you the science behind it, all right? So the loan is going to be at 50K, right? At 10%. And remember, this is going to be for 10 years. Okay, so we circle that 10 for 10 years. Now, remember where the minimum monthly payment goes. Okay, the minimum monthly payment is split up and is absolutely derived in large part from the interest rate. So this $660 each month is getting split up. This $244 of the $660 is going where? That's right. That one is going to you, which, by the way, you have to go ahead and apply that to the principal. And then the $416 each month is going where? Away from you. Remember, when we're talking about loans, we're talking about something that you can only pay one way, and that is away from you. And that's why we like lines a whole lot better. But $416 is going to interest, and then the $244 is going towards that principal. Now, if you pay that way, they've said, this is your schedule, this is how long you're going to be in the loan, but then you come across some education and you say, wait a minute, I don't have to be in it for that long. And they start getting nervous. And that's okay, because now you know the power of using your money. It doesn't matter if you have a line of credit or not, but you're going to use your money in a way that you're going to leverage yourself right out of this loan. And the $660 each and every month is going to be going to you. Now, Just a side note here, this 50K can be an auto loan, it can be a student loan, personal loan, business loan. It doesn't matter what type of loan this is. All that matters is getting out of it so that you can capture this cash flow as soon as possible. So here what we're going to do is we're going to go ahead and utilize what is called our line of credit. Now I know there are some that don't want you to use your line of credit. There's some that want to say, listen, you got to cut up your lines of credit. But that would be like saying, hey, you got to cut up your leverage. And what sense does it make to cut up our leverage? Listen, it's not doing anything right now. So we might as well go ahead and capture this cash flow by deploying the right amounts of line of credit towards this principle. Now, if you do not feel comfortable exercising the deployment tactic of the full $10,000 towards your principal, that's okay. You can also do it in smaller amounts. What counts is that you are hitting the principal. We don't want to split up the payments. We don't want to split it up so that the interest and you're still paying more to the bank than you are the principal. No, we want to be paying more in principal and less in interest. So how are we going to do that? We're going to do that by deploying as much as we can towards that $50,000. Now, let me show you what happens when you deploy the whole $10,000 towards this principal balance of $50,000. Now, remember, if you stay in this loan for the full duration of time, 10% at 10 years, you're going to end up with over $29,000 in interest. However, if we are deploying our line of credit and using our line of credit in a leveraged, more efficient and effective way, you're going to see how much in interest you're going to save. So let's just go ahead and get down to it. 50K minus 10K is going to be 40K. All right. That means the 10% is now eating the 40K, not the 50K. All right. Now, why do we need to know that? Well, because when you're dealing with interest and principal, you're dealing with parasite and host, respectively. Because the interest is feeding off of the principal. Okay, so the bigger the principal, the bigger the interest. So what we want to do here is we want to eliminate this as soon as possible. Now, I know what you're thinking. Hey, CJ, you still have this to address, okay? We still need to see what you're doing to get rid of both of these debts, because guess what you just did? You just created another debt. Well, did I though? Because with the line of credit, what you're going to do is you're going to make sure that you do math the correct way. Now remember, we're not going to put the 10K in the denominator position. No. What we're going to do instead is we're going to go ahead and say, well, wait a minute. I'm making the cash flow of $2,000 each and every month. I can put that down here, use my line of credit as my new checking account, and now the equation can look like this. 10 divided by 2 equals 5. 5 months. You're going to be out of the $10,000 debt. That means each time you deploy your $10,000, if you are using your line of credit as your new checking account, that means that $5,000 that comes in, let's say, in income, you're going to park it right there in the line of credit. And of course, you got expenses, this included. So you're going to subtract the $3,000 that comes out of the line of credit, and it's going to leave you with $2K. May I ask you a question? What is that $2K doing? Paying the line of credit down. Now you can do this with a line of credit. You can do this with a business line of credit. You can do this with a credit card. All right. There are avenues and even initiatives out there to where you can do this so that your cash flow is not just sitting there. You see, this cash flow, even though we said park, it's doing more than parking, right? It's paying that line of credit down. You always want your money moving, all right? So 5 months to get rid of that 5K, and now all of a sudden you see something, don't you? You see that, no, it's not going to take you 4 years, not even 3 years to get out of this debt. And now you're seeing a way to pay this off even faster. So the question then becomes, how many 5-month increment $10,000 deployments, right? Because you're going to be deploying it every 5 months, because every 5 months you're going to be paying it off. But how many of those 5 months are going to go into paying this loan off? You want to see? Well, let's show you. All right, so remember, it's Christmas time, and we've got to make sure that we know how to pay off not only our bills, but every obligation that we had before, right? So we understand the traditional banking method is not working for us anymore. We've got to try something else, and that something else is velocity banking, all right? So let's do this. I remember there was a commenter, shout out to you, and he said, CJ, you're actually miscalculating. You'll actually come out of that loan much sooner because you are not putting in there the monthly payments. So you don't calculate those. So you made a mistake there. But he just proved my point. You see, even when I over round and I give a couple $100, right? Even more than what it usually is, you're going to see the power of velocity banking and paying your debts down, because you're going to notice that I have not included the minimum monthly payments in there. All right. So even without including it, velocity banking still works. So 0 month, right? 50K. All right. First month we deployed the $10,000. Now we're at 40K, right? The 6th month, notice we didn't subtract from the minimum monthly payment at all, right? We're just simply doing the deployments of the $10,000, right? 30K, 12th month, now we're at 20K. 18th month, now at 10K. 24th month, we're now at 0K. And so we're just deploying like crazy. What happens when the lenders see you using your line of credit wisely, actually using your line of credit? Have you ever been a victim of a credit line increase to where this number actually becomes this number? Have any of you witnessed that? I know I have, all right? And this is beautiful, because you're not going to do that with a savings account. You're not going to do that with a checking account. You're not going to do that with these other accounts. The bank is not just going to give you money like that because you're a good steward, all right? But they will when you're dealing with lines of credit, all right? And so the question might be, okay, well, CJ, how much did I save in interest? All right, let's just go ahead and round down, okay, for the traditional bankers. In traditional banking, if you were to continue on with the $660 each and every month, you're going to shell out over $29,000 in interest. All right. Now, for velocity bankers, you choose to go ahead and use stagnant money, right? Money that's not doing anything. That line of credit, you're just waiting for something, I guess, right? You're going to use that instead. This is how much you'll be shelling out in interest, okay? $3,400. And really it's less than that, but come on, right? So $3,400 versus $29,000. And oh, by the way, you're out of this loan in much less time, in about 2 years instead of 10 years. So it wasn't 10 months, all right, full disclosure, but it was less than 10 years. It was 2 years or 24 months, okay? And a whole lot saved. So my question to you is this: what are you going to do with $660 extra? Well, first of all, guess where it's going? It's going straight over here to your cash flow section. You see, what you're doing as you implement the velocity banking method is you're actually doing a time collapse transaction. And time collapse transactions are something that our Money Max folks, they know about all the time because they're frequently paying off $500,000 in 5, 7, sometimes 10 years. And they're wondering why in the world are they just now knowing about this? Well, that's okay because the company was founded by a couple of lenders who just really cared about folks. And so, folks, let me get on out of the way here and share with you that you are not doing this alone. This Christmas season, I want you to give your whole family, your community, the gift of velocity banking. Show them how to do this. Share with them that you no longer have to look like a slave to this 21%, 30%, 40%, because when you're doing it the velocity banking way, you are obviously not going to be paying that. All right? So God bless you. We'll see you in the interest rate video. So the minimum monthly payment is $660, split up between what? $216 going to your principal, and what is that? $344 going towards your interest, right? So $344 here. So here we have a situation where, again, you are faced with another definition of usury, okay? That means excessive interest. What we want to do is we want to take this equation right out of the picture, meaning this $344 and $216, we want to flip that. So this $660 each month is going to be split up, remember? $244 is going where? That's right, not to you, right? No.